Some retirees want to know, should I sell my stocks and should I move into something safe, an interest-bearing account like a CD, treasury bills, even a high-yield savings account? After all, interest rates have gone up significantly this year and the stock market has been a roller coaster. Hey there, it's Alex and Anthony from 1 Degree Advisors. We are certified financial planners that help folks with all things tax, retirement, and investment related. Stocks and bonds are down pretty big so far here in 2022. And a big driver of that is interest rates have gone up so much so quickly. Now, the silver lining in all of this is that folks can actually earn some decent interest in their savings at the bank. They can also earn a pretty good yield on things like treasury bonds, which, maybe paying 3 to 4% on the type of bond you get. A couple of years ago, that wasn't even possible. So a question people are asking themselves is, why should I not just sell out of my stocks? They're super risky. It's been a roller coaster ride. Right. And why shouldn't I pile money into these more safe investments that are guaranteeing me 3 to 4% interest, if not more?
Yeah, it's a good question. And no one was asking this in 2021 when stocks were up over 20%. Bank savings was essentially paying near zero, but times have changed. And so it becomes a valid question. I would say first that everyone needs to evaluate these types of questions on your own unique goals, your own timeline. So what I want to do is basically show you a simple plan that incorporates cash type investments, but can also include growth investments like stocks and hopefully help you sleep better at night.
Okay, but before we get into that, I think it's important. Let's look at why completely selling out of your stocks and like growth investments is not a good idea for most people.
Yeah, recent inflation numbers were still at 7.7%, okay, and they've been over 8%. So if you're only invested in cash, and we're going to take a look at this graph here, and essentially the blue line is, which you see very much at the bottom there, is inflation over the long term. The green line, which essentially matches it, is cash investments. This goes back over a 25-year period. The orange line, which significantly outpaces both, is stocks. And what we have to conclude is that historically cash barely keeps up with inflation, if at all.
But in the moment, when you take a look at these short periods of time, it can seem really difficult, right? Because yeah, it's easy when I look at this big long chart, but once I condense this down into right here, right now, it can seem really tough. But that's where good planning can come into play, and there really is a better way. A lot of people are just making investment decisions without a plan, and your money needs to be aligned with your personal plan, your timeline, your objectives, your overall retirement plan. Like, all these things are so important.
Yeah, that's right. Let's take a look here. So this is like a way to typically structure. It's just very general in nature. But down at the bottom here, you have cash. And so that is your savings. Maybe it has its CDs. You mentioned treasury bills. This is essentially short-term money that you may need in the near term, whether it's an emergency that comes up, you're saving for a home remodel. It's just money to help you sleep better at night. Perhaps it's providing a regular income stream to you. You want it to be stable and not fluctuate in value. Now, maybe in the middle here is where you have like bonds and other intermediate type investments. There is going to be some fluctuation, but you can earn a higher return than cash over time. And then at the top is where you have your equity investments. So we're talking about stocks here primarily, but this can also include things like real estate and business interests, generally where you have an ownership where you're going to get the growth over the long term, but there's going to be significant fluctuation in the near term. Now, keep in mind, this is not money that you want for cash, for income here and now. It's money for later, significantly further down the road.
And look, we're not saying that cash in the bank is not important. We're saying it's incredibly important, but people need to be aware what their bank is paying. A lot of people are not understanding that their traditional bank, their traditional brick and mortar, is not paying them the interest that they probably should be getting. And there are alternatives to be getting those higher interest rates. We recently posted a video. People should check that out. Once again, this is Alex Okagawa with 1 Degree Advisors. And if you're interested in learning how we help retirees build a long-term plan and balancing that with their short-term needs that can help reduce worry, visit our website at onedegreeadvisors.com.